All right, let's begin with the last topic we finished. Remember, okay, for this class, I think from my past experience, for most of the students, you need to overcome this concept, debit, credit concept. That is, I think that's the most confusion, if not one of the most. Okay. So highly recommend you can overcome that concept as early as possible and write it down in your notebook, or you can copy. I think from your book. I sent you the slide already. I hope you have received my email. If not, please contact me. Another minor item is your first homework due on tomorrow. So most of you turned in already, so really I'm really appreciate it. But for those of you have not turned in yet, please do so by tomorrow 6 p.m. I believe. Send the email to me. Well, you have your option not to do it, okay? If you say I'm so busy and this is the summertime, I think you're good enough already since you're sitting here instead of at beach. Really appreciate it. So you have a options if you don't do that. But if you don't do that, the best final grade I can give to you there will be B. So if you think that is acceptable, at least not F, right? So yeah, you will get a B. The best is B. So I think this is fair enough. Okay, you're sitting here, I really appreciate it. But if you turn in your homework, including those people you're watching this video, the best I can give you what will be. So if you participate, turn in your homework, midterm exam, your final project, to get A is not that difficult. I'm not that concerned about how many people will get A. I don't have the quota. Okay, so for the whole class everybody can get A. But if you choose to say, oh, I just don't want to turn in the homework, I'm so busy, then it should be fine. But the best is get a B, you get a B. So don't complain to me if you are the only one get a B, okay? Because I announced this already. So we have Joanne here, we have, is James here? I don't believe so. Is Mr. Chi here? I don't think so. Mr. Chen, Peter Chen is here. Joanne is here. Peter is here. Is Mr. Xiao here? I don't think so. Mr. Cai, Kila is here. Or Kali, I'm sorry, Kali is here. Is Dyson here?
Yes.
Dyson is here. I see Jim is here. How come I don't see your name? Jim? Oh, okay, you use a Chinese name.
Yes.
Okay. Xiao. Alright, got it. Okay. Remember last time we finished a few examples, but right now I just want to get a little bit refresh. Okay, there are 5 major accounts or 5 major categories for our financial accounting. So for the purpose of balance sheet, we need to learn assets, liability, and the equity. And remember, for the debit side, credit side, if you determine this item is under the assets category, when the assets increase, we put that number on the left side or say debit side. All right? If opposite, if the item under the assets decrease, then we put the number on the right side or say credit side. Eventually, you only need to learn this. This is it. Because if you determine the item is under liability or equity or revenue, then they are all on the opposite. Got it? So even though I say remember 5 categories, eventually you only need to memorize 1 category, assets. Okay? Once you put in the right side under the assets, the other thing just follow. Just follow. Alright? So for the liability, for the equity, for revenue, they are all on the opposite side. And then the last one is expenses. Expenses is under the same side as assets is. The reason why is the expenses gonna offset the revenue. Alright? That's it. That's it. Okay, that's all you need to keep in your mind. Then we can continue our discussion for throughout the whole semester. We just follow the same basic principle. This is it. Oh, by the way, your name, please.
Yao Hai Hong.
Last name?
Huang.
H-U... Oh, yeah, here. Thanks. Alright, so this is the slide. I need you keep in the front of your note, okay? Because you may need this once in a while to get the reference, and also probably for your homework purpose, for your midterm exam purpose, you do need this. Alright, just follow the same principle I just mentioned. So I think this is on your page 61. Okay, so for your book 61, this is a very important page. Alright. So for today, we will begin with the chapter 3, income statement. So anyone still remember what's the basic format? What's the basic structure on the income statement? Everybody? What's the formula? Income statement, you will see
income minus expenses.
You can say income, but I would rather say revenue.
Revenue.
Okay, by the way, so the format is so simple, okay? It's the revenue deduct or minus expenses. Then we see profit. So I try to differentiate the terminology revenue and profit. So when we say income, it's kind of a little bit ambiguous. Because when we say income, you got confused. Is income mean revenue or mean profit, right? So I try to differentiate a little bit, right? Sometimes we can put income as same as like revenue, but be careful. Income is not profit. Got it? Right. So for chapter 3, very important. Okay, we need to differentiate what's the revenue. We can say revenue is income. That's fine. But revenue is not profit. Just be careful. All right? Anna, putting your name information here. We would rather go slowly, okay, to establish your concept. Because for the lay person, for our daily regular conversation, nothing wrong we interchangeable revenue with income with profit. That's fine, you know. But when we talk about financial accounting, especially when we talk about income statement, that is big difference. All right. Revenue may similar to income, but never confuse revenue with profit. Profit means revenue deduct your expenses. This is number one. Okay, so remember, revenue is not profit for the purpose of the discussion for income statement. Number two, when we say expenses, we simplify a lot. We simplified a lot because I just want to simplify the whole formula for you to remember the whole thing easily. However, when we talk about expenses, sometimes for the calculation purposes is interchangeable as cost. When we say gross revenue minus expenses, sometimes that include the cost. We will discuss that. In our terminology, is more specifically is the cost of goods sold. All right. So let me give you an example. Okay. By the end of the whole period, we calculate for this period the total sales. Okay. Sales sometimes mean revenue, mean income, gross income. So the gross sales is $1 million, and for the same period, expenses is $800,000. So very quickly we calculate for the same period, our net profit is around $200,000. All right. So here I just want to emphasize, when we say expenses, sometimes mean cost also. Okay, we mean cost. However, in the future when we discuss for tax purposes, then be careful, very, very carefully. Expenses is not cost. Am I clear so far? All right. Because right now, when we, for this class, for today, when we just discuss income statement, we may interchange the terminology expenses and cost. Sounds like interchangeable. Sounds like in the same category. All right, because revenue minus expenses, all including cost, then we receive the number that is profit. So for this class, expenses, cost, we mix that, is fine so far for today's discussion. However, in the future, if we have any chance or for you to do your final project, you do your independent study, when we see expenses not necessarily similar or equal to cost of goods sold, especially for taxation. Let me give you one reason, okay? Let me give you one reason. For the tax purposes, when we say expenses, that means that number will be deducted in the same period as expenses to calculate your net profit. All right. So for income statement, the number we can deduct from revenue, eventually that is really true expenses. However, in today's example, we'll see cost of goods sold. We see terminology cost there. Cost of goods sold eventually is really expenses. All right, it's really expenses. However, down the road, when we see another cost, especially the cost from fixed assets, say for example, you spend $500,000 to purchase office, also with the land, okay, real estate property. Then that number, $500,000 we discussed from last time already, we know we cannot deduct that as expenses in one time. So for example, by the end of the whole period, we cannot deduct $500,000 as expenses. So when we say cost, for the purpose of taxation, cost eventually become basis. So just be careful with this terminology. Okay. When we talk about cost, be careful. Okay. For financial purposes, it may mean cost of goods sold. If we talk about cost, and it is cost of goods sold, that is expenses. We'll see example very quickly. So cost of goods sold will be deducted from gross revenue in order to calculate profit. However, when we talk about cost, say equipment, automobile, real estate, personal property. So here, if say cost of good, that means inventory, okay? in this category, it is expenses. All right. However, when we mention cost as the basis, then we cannot deduct the whole number as expenses. If cost mean basis, mean the money you spend to acquire the assets. Remember we talked about this last time? It's subject to what? Depreciation. Only the portion of depreciation could be deducted. Could be deducted. Everybody got a point? Anybody? Depreciation is a big topic. It's another good candidate for you to choose as your final project study. All right? Depreciation. We'll have one chapter where we'll talk about depreciation. We'll talk about that. So at this moment, this is chapter 3. We just give you a very general outline. Okay? So keep this in mind. When we talk about income statement, we will see gross sales, or say gross revenue, or say gross income. This is the item number 1. And following that is expenses. And expenses really include cost of goods sold. And then we will see net profit. Sometimes we say profit before tax. Okay? So be careful. Each terminology, we must be very, very careful to differentiate. Okay, stop for a while. Okay, when we talk about the sales, okay, remember this course is based on the assumption the business adopt accrue method. Accrue method, we discussed this from last time, right? Accrue method really mean when transaction incur, when any transaction happen, even without receiving or spending cash, we will enter this transaction. Okay? So some major item you can foresee. When sales happen, okay? When the sales happen, let's talk about what is sales happen, because this is a big issue. Say you are the vendor. Your business receive an order from your customer today. All right? You receive a PO. And this is the existing customer. You've done transaction for a few years already. And your practice is you ship merchandise out or you provide your services, but you don't collect the money right away. Okay, for this customer. And this is a very good customer, never overdue. They will pay you in 30 days. Okay, on this PO you receive today, it mentioned and both parties agree upon. When you receive this PO, within 10 days, you will deliver your merchandise. Another 30 days, after you deliver your merchandise, another 30 days, this customer will pay. Say for example, you don't have any problem to prepare this merchandise, even though probably not in your warehouse yet, but there's no problem. You can get the merchandise from the open market, and no problem you can deliver it within 10 days from the PO day. Alright, say for example the total value is $100,000. Alright, so let's talk about that. So today, when you receive this PO, when you receive this purchase order, based on the accrue method, do you do any accounting or bookkeeping entry? Am I clear so far? My situation, am I clear? Today, you received PO from your very reliable customer. The PO just mentioned very concrete, very certain what kind of merchandise and what's the unit price. However, you don't deliver it. You can deliver anytime, by the way. Okay, as long as you can deliver within 10 days from the PO day. So my questions to you is, on the day you receive this PO, do you do any bookkeeping, any accounting transaction on the day you receive this PO? What is your answer? Or you're not clear about this question yet? Do you understand the whole situation? The situation is on the PO day, the day you receive PO. Would you do any entry for your accounting bookkeeping? Would you? Yes or no? Yes or no?
Yes.
Why? Why yes? Or if say yes, how do you do it? Remember, when I say entry to the book, you need to find out at least 2 accounts. You need to find out at least 2 T accounts, and you enter the number in it. That's what I mean. Bookkeeping. If you say yes, let's talk about. If you say yes, what are the accounts you will pick?
Assets and expenses?
No, too far away, because today is only the day you just received the PO. You just received the PO and you don't do nothing. You don't do anything. You just receive that, and probably internally. By the way, usually it is the sales department receive the PO, right? Am I right? Usually it is sales department, not the accounting department, right? Usually for the flow, right? For the whole internal operation flow, right? It is sales. Oh, by the way, it's a one-man company, so you are the person who received, and you are doing the accounting. But theoretically, it is the sales division, sales department receive the PO. Then you generate the internal voucher or enter into the computer, right? Then the information will go to at least 2 departments, right? One is accounting, right? The other one is your manufacturing. Go to the operation department, and the either your factory or your inventory people will look at your purchase order, then prepare the inventory, prepare the merchandise, and maybe you have a QA people to do the quality control. That's another thing, okay? But to simplify everything, on the day your company received the PO, eventually, for accounting purposes, you don't do anything. You may do a lot of things. You may do a lot of operation, but at least for bookkeeping, at this moment, you don't do anything. Am I right? Or you have your opinion? You have different opinion? You say, oh, no, I will do something. If you want to do something, you tell me what are the accounts you will pick. I will say probably no. At this moment, you don't do anything. You do a lot of things, but not related to bookkeeping. All right? So at this moment, you don't do anything for your bookkeeping purposes. Okay, then, on the day you ship out, on the day you deliver, say you deliver the whole merchandise, $100,000 value, you deliver it. Okay, on the day you deliver, what should you do? This is very complicated, by the way. It's not easy. For accounting purposes, how do you enter your number to your book, to T account? Any idea? Oh, by the way, this is no cash receipt, okay? Remember I said no cash receipt, but for the accrue method, even without received cash, we need to do something. So you have any idea what accounts we need to pick? Correct?
On asset side, accounts receivable.
All right, very good. Everybody agree? Right? when we deliver $100,000 value merchandise and we expect to receive it within 30 days, so for sure account receivable change, right? Very safely, I think we can pick out account receivable. And by the way, I think another difficulty for us new student is you need to put on in the right category. Account receivable for sure that is assets, right? If you have any trouble, go back to check our book. Okay, 5 category, right? Assets, liability, equity, revenue, expenses, right? All right, so let's go step by step. So we pick out AR, there's no problem. And AR, account receivable, for sure, that is the assets category. Because you need to define, okay, or determine which category it is, then you can determine plus, minus. This is very crucial. So far, I think it's no any problem. All right, so we have account receivable increase. When I say this, I mean debit, okay, by the way. So this is the assets item. Okay, this is the assets item. So assets item increased by $100,000. Tell me, which side we need to put in? Slowly. This is the assets. Look at here. Look at you. This is highly recommend. Sometimes just don't use our mind. Use our eyes. Okay. So look at this. Yeah, left or say debit. Okay. All right. So this is fine. We just try to practice. All right. Try to practice. Okay. This is number 1. Okay. Step one. Account receivable is assets item. So you look at your right hand side. If it is assets item and increase, determine this is increase, right? So step 1 we determine this is assets. Step 2 we determine this is increase, not decrease. Then when you look at the chart, you see when assets increase, that is debit side. I know people always got trouble say increase. How can increase is debit? Because in our daily language, when we say debit mean decrease, right? Right? Am I right? So, however, we are not using debit credit here as a literal meaning. There's no any literal meaning here. Debit credit for T account purposes only mean debit on the left, credit on the right. This is it. So I know people got very big trouble is how come assets increase we use debit, right? Because when we say debit, usually debit mean decrease, but forget it, okay? Forget it. For T account purposes, debit, credit only mean debit on the T account left side, alright? So whenever we got confused, just look at the chart here. So when assets increase, we just put on the debit side, okay? So let's have a little bit compromise with our daily language, all right? Okay, when we pick out account receivable, don't worry about you made a mistake here, okay? Because I say this is not the easy one. And for the sales transaction, every time when we involve sales, when we talk about sales, let me give you a hint, okay? We may need to pick out 4 accounts, not just 2. We may need to pick out 4 accounts, not just 2, okay? So when we go by this example, if you make any error mistake, that's fine. Don't worry about that, okay? Okay, so right now we need to pick out another account in order to match this $100,000 number. Also, their account will reflect on the credit side. So, which account you would like to pick? Yes, yes. Every time we have sales, okay, this is another hint, okay, another tip for you, okay. Every time when we involve sales, you pick up revenue safely, very safely. All right, revenue. Sometimes not necessarily account receivable, okay, but almost for sure you pick out revenue, because if this is a cash deal, you don't have account receivable, but you still have revenue. Okay. So you have revenue or say sales or whatever, the similar will be fine. Okay. And you look at the chart, okay. Either you look at the chart or you can look from here. So when revenue increase, that is on the credit side. You have revenue by $100,000. So at least right now we balance. At least right now we balance. When I say balance, because we have about 100,000 on the debit side, we have 100,000 on the credit side. So at least right now we balance. And some people just stop here. Some students say, okay, I finished, I'm done. But no, not yet. Why? Why? When we ship out $100,000 sales from our inventory, another item under the assets also change. What's that item? Everybody? When your company ship out merchandise, deliver that to your customer, one item under the assets also change. What's that? Good. Inventory. They really mean under your assets, your operation is you change the quantity of inventory to account receivable, right? So don't stop there. Okay, when you have revenue, when you see account receivable, don't stop there, because not yet. You have not complete. You have not finished yet, because inventory also change. And also another thing is, for the normal business operation, I say normal, okay? For the normal business operation, the value of inventory usually what? Usually less than the price you sold to. Am I right? Otherwise, it does not make sense. In order to run business, you want to make profit, right? So unless you want to liquidate something, okay? Unless something really special happen. Otherwise, we know the value of inventory should be less than the value you sold to, you charge to, you bill to your customer. Otherwise, you lose. There's no any sense. You lose money, when you run your business. Otherwise, you want to liquidate your inventory. You want to dump something, okay? So let me just give you one very, very simple example. The value of inventory is $75,000. So very quick calculation, from this sales, your company make $25,000. Not too bad. Very good deal. I just help my customer finish one transaction, and that is real estate transaction. And my client, I should say, because that's from my law practice, is a small builder, okay? Just very typical business model. We will talk about business model next semester, okay? After this summer, I will teach entrepreneurship. One topic is very important, that's business model, okay? And for this client, the business model is so simple. Just find the very old, 60 years, 70 years old single family home in very prestige area, say Palo Alto, all right? And buy it, tear it down, rebuild. And this example is, a few years ago, he or she purchased the old house there, say $1.2 million, all right? Tear it down and spend another $1 million, including construction, including soft cost, everything, another $1 million. So say for example, the total cost 2.2, 2.3, and guess what? The house, once been built, sold on the market, and you know, since last year, the real estate market in Bay Area, especially in prestige area, so booming, just fried, and sold at 3.3. So 3.3, 2.2, profit is very, very high. And it's probably like 40%. Like 40%. All right. So this is the regular business operation. All right, here. When we recognize inventory reduced by 75,000, what account you, Mariana, you mentioned already, inventory, okay? Inventory, we pick up inventory, okay? Inventory is another account under assets. Remember, okay, every time we pick out the account, we always have 3 steps analysis. Always 3 steps analysis. Step 1, we need to pick out the right account. So for this example, we need to pick out, like Mariana just pick out, we need to pick out inventory because this is merchandise or ship out. If you pick out, say, fixed assets, you're wrong. Okay, so step 1 analysis, we must pick out the right account. So inventory is correct right here. Step 2, we need to verify this account is under which category. Sometimes we pick out the right account inventory, we thought this is liability, we thought this is expenses, then wrong again. Inventory is under the assets category. As I said, if you had any trouble to put down in the right category, always go back to the page I sent to you. All right? So step 2 analysis is we need to identify this account under which category. I think, up until today, we should not have any trouble to identify inventory is assets. We should not have any trouble. Otherwise, you go back to check your book or check back my slide, okay? So step 2 analysis is we need to identify which category this account belong to. And step 3, look at your chart. Since this is assets category, decrease. Assets decrease, right? All right? So we put down under. Oh, by the way, while I'm talking, okay, I made a mistake, okay? I made my mistake. So if I do make mistake, remind me, okay? Don't follow on my mistake. Otherwise, everything for the whole class we're gonna discuss the wrong way, okay? So far I believe, so far so good, all right? And for next one, maybe a little bit trouble for you. To match this 75,000 on the credit side, we need to pick another number or another account to match this. Which account you would like to pick and happen to be 75,000 on the debit side? Maybe difficult, but we need to go through this in order to go into our example for today.
Why again, you just sold inventory
Yeah, something like inventory. So what's the account name? What's the name of the account? And always remember, right? 3 steps analysis, right? Step number 1, we always need to find out which account. What's the name of the account? Number 2, their account, which category their account belong to. And the hint here for you is must be $75,000 on the credit side. This is the hint for you. Well, if you cannot answer it, it's fine because this is new for today. Yeah, Colin.
You mean you use 75,000 on the debit side because we just put 75?
Right now we done already 75. I'm sorry, thanks for correct. So right now we done 75,000 on the credit side already. So thanks for correction. We must find another key account that shows 75,000 on the debit side. On the debit side. So step number 1, which key account? What key account we need to pick?
Cash.
We don't have cash right now. Remember, right now we just deliver the merchandise, so no cash change hand.
Okay.
What do you
Understand.
Any voice I can hear?
cost of goods sold?
Mariano? Say it again.
Cost of goods sold.
Good. Cost of goods sold. Cost of goods sold. Okay, I want to pause for a few seconds. We pick up cost of goods sold. So step 1 analysis, we got it. Bingo. And then step 2 analysis, which category cost of goods sold belong to? 5 here. Louder. Expenses. Eventually there are 5 categories, but you exclude 2 already, because when cost of goods sold increase, that is on the debit side. So you exclude 3 categories already. Only 2 categories will give you increase on the debit side, either assets or expenses. And of course, cost cannot be in the assets side, never, right? So as I said, when we talk about cost and expenses, at this moment, we can mix together. We don't differentiate. So cost of goods sold, step 2 analysis, that is under the number 5, expenses category. Good? So pause for a few seconds. Everybody follow us so far? Right? Follow us so far, okay? So we have cost of goods sold, and from today on, no any problem, no more. Cost of goods sold belong to expenses category. So see number 5, when expenses increase, no doubt, okay? So we have 4 accounts, okay? 100,000 increase on account receivable. 100,000 also increase on revenue. All right? 75,000 reduce from your inventory, that's assets. And you have 75,000 increase under your expenses. And this transaction then finish. This transaction finish. And you may ask me one question. How about net profit? How about $25,000 net profit? Where is it? How come we did not enter into a book, say, hey, we made $25,000 profit for today? Where is the $25,000? How come it is not on the book yet? I say yet, okay? It will reflect, but not right now. So you may ask me, hey, Professor Tong, did you forget this $25,000? Did we really leave something out? The answer is no, we did not leave out. Because the profit, remember, on the income statement, that is by the end of the period. You don't need to worry about the profit for the day, because we don't calculate the profit on everyday basis. Got it? As a businessman or businesswoman, we are so anxious to see how much money we earn today. But for the accounting purposes, we don't calculate the net profit on the daily basis. You may see on your computer screen how much money you made for the day, but for the accounting purposes, we don't do that. By the end of the period, say month's end, the last day of the month, we will see how much money the net profit we made, because that is the result. That is not the process. This is a process, okay? By the way, everybody, we're doing this. This is an accounting process, right? And the net profit, this is a result. We don't care about the result. I more care about the process. We will see our result. If you really want to read the result on the daily basis, still okay, because we don't need to bother it, right? By the end of the day, the computer will calculate what is the total revenue, deduct the total cost of goods sold. You will see your daily result. So for the $25,000, we don't care about that. By the end of the day, or by the end of the month, by the end of the year, we will see the net profit under the bottom of your income statement, and then we close the book. We transfer that number to equity. Remember we talked about this from last time? Income statement always say revenue and expenses, those two categories, they are called temporary accounts. Temporary accounts. Temporary accounts just mean revenue and expenses. By the end of